All right. Weekly chart. We're pulling back and we triggered the sell. We triggered the sell below the low of last week. Probably going to find buyers and go sideways. However, probably a weak high one buy next week. And so I think the odds are against the market just getting a strong, sharp reversal up. And more likely we'll be sideways here. Let me just check something. All right. Sorry about that. So anyways, I think probably buyers below, but probably a weak high one buy next week. So probably sideways on the weekly chart. Daily chart, we're around the midpoint, and now we have a bad sell signal bar. It's an inside bar, so technically a breakout pullback sell, so a low one. Probably buyers below the low one. And probably sellers somewhere above. But bull trend, we have a lower high, trend line break to a higher high. I think we'll have to form some sort of lower high major trend reversal before traders can get a second leg up, or before the bears can get some kind of major trend reversal. And that's assuming the bears are even successful in the first place. Realistically, we'll probably go sideways and form a trading range. I think the downside's probably limited. There we go. 5-minute chart. On the 5-minute chart, we gapped down and formed a bear bar with a big tail below the bar on bar 1. And that is a strong enough breakout. And we may have to go sideways, but realistically, we're low. We're low in an overall trading range from yesterday's bar 30. And therefore, this is probably more of a buy zone than the sell zone. 2, bull bar, good for the bulls. Opening reversal after the gap down. Probably will test up to 81, but we may end up having to go sideways for several bars before the bulls can get a credible reversal up. 3, bear bar, second leg down attempt after 1 and the gap down. We're probably buyers below 3. And then 4, we formed a fairly large bear bar and reversal up. What about buying the close of 4, betting that it's a strong reversal and a stop entry buy? Well, you can, but before you take a stop entry, it's always really important. I mean, really, before you take any trade, it's always important to think through the math. If you buy above 4, what is your risk? Well, your risk is easy. It's the bottom of 4. And therefore, what's the reward? Maybe a measured move up. So if you buy here, you have to ask, what's the probability we're going to go all the way to the upper third to this area before we pull back? And if you stop and think for a second, you think, that's a lot of risk relative to reward. And therefore, maybe it makes more sense to do the opposite. And that's why we pulled back on the next bar. 5, doji, but probably some traders buying the midpoint of 4. Overall, tight trading range, and therefore we could still go mostly sideways. So not ideal. And then 6, another bear bar closing on its low. Good for the bears, but probably more traders buying down here than selling, and therefore not ideal. And then 7 outside up, second leg up for the bulls who bought above 4. Good for the bulls. Many of those bulls were willing to scale in lower, and this might be a credible 2 legs up, leg 1, pullback, leg 2. But we have targets above 81 close, and the outside up bar on 7 is strong enough. Is a strong enough surprise that the odds favor. It's a strong enough surprise. Odds are we'll go at least a little bit higher, and therefore probably more traders buying up here than selling. Follow through 9. Follow through 9, good for the bulls. Probably going to go at least a little bit higher. And then 8, follow through, good for the bulls. Probably going a little bit higher. 9, a doji, a warning that we may not go that much higher. And then 10, bull bar, trying to break out after 9. But this is getting near resistance, the low of 81. And that increases the risk that we form more of a trading range here. 11, inside bar, probably not going much higher. And then 12, outside up, good for the bulls, probably going at least a little bit higher. But look where you are. I say going a little bit higher, look where you are. You have basically a spike, 7, and channel at resistance, and 12 is an outside bar. And therefore, it's an implied parabolic wedge in a trading range day. And the symmetry is really not great. When you look at this rally, does this rally from 7, the low of 7 to 12, look like the low of 18 to 24? Not really. And therefore, we might just be sideways here. Bear bar 13, strong enough reversal down, probably going to get at least a second leg down. And then 14, consecutive bear bars, probably going to go at least a little bit lower. What about selling the close? If you sell the close, you're selling a 50% pullback from the rally, and that lowers the probability for the bears and increases the risk that we have to get a bounce. But as far as buying the midpoint after 14, I would not. To me, it makes me think that there's probably more traders looking to sell a pullback than buy. So if you're buying, it's really a scalp. And for me, I'm really not all excited to buy. Now, look where we are. We're pausing at the open of the day. And when you're in a trading range, it's relatively common for the market to test the open several times. And therefore, we may get a bounce here. Bull bar 15, good for the bulls. High 1 buy, breakout, pullback, buy. But after 13 and 14, I'm not going to buy above 15. If anything, I think 15 is probably a sell above, but it may lead to more sideways trading. And then 16, bear bar closing on its low. And what do you notice here? It's kind of interesting. 15, bull bar closing on its high. And now 16, we have almost an equally strong signal bar for the bears. Think about that. That means you're in a trading range. You're getting strong buy signal bars and strong sell signal bars with really not great context. And that's a warning that something is not quite right for both sides. And because of that, the bulls got a second leg up on 15 after 15 with 17. 17, bull bar, good for the bulls, but we have a low one short 16. And I suspect the bears selling below 16, scaling in higher, probably make money. Is this going to be the same as, this right here? Bull bar and then a weak low one and then higher prices? Well, not really. I think this is a stronger sell-off and this is a stronger low one. And that makes me think there's probably sellers somewhere above. Doji, 18, but not a strong entry bar after 17. So we probably may have to pull back. And then 19, by pullback, I mean pull back to the downside. 19, variation of a low 2, low 1, 16, low 2, 19, tail below the bar. Might be more traders buying below, but I think there's probably sellers above 19. And therefore, it's really not a great buy in this general area. Follow through for the bears with 20, good for the bears. Probably a bad high one above. Not a strong entry bar, and therefore we may have to go sideways. But I ultimately think the bears selling below 16, scaling in will make money. And you can see what happened. Weak high one buy 20, and most traders gave up 21. What about selling the close of 21? Well, the problem with the trading range is when you have clarity, usually the market ends up going sideways. So if you're going to sell the close of 21, it's really not ideal. You're selling a strong bar, and that increases the risk that the market you're selling a vacuum test of support, and that increases the risk that there's buyers down here. So really not a great place for traders to be selling. Strong bull bar 22, good for the bulls, 2 legs down. Probably going to try and get some kind of reversal up. Follow through buying 23. Good for the bulls. Consecutive bull bars, probably buyers below in a bounce. And we have a doji 24. Doji 24, we have a pullback 24, and it's basically a trading range bar. Probably buyers below 24 and at least a second leg up. However, I think the bears who sold 21 and scaled in higher will probably make money. 25 second leg up for the bulls, minimum expectation. We may need a third leg up after 22 and 23 being consecutive bull bars. Pause 26, not a great signal bar for the bears, and therefore increases the risk. Not a great signal bar for the bears and increases the risk that we get some kind of pullback. And then outside up, good for the bulls, but a third leg up, 1, 2, 3, probably going to try and reverse down and test somewhere down here. This is not enough for the bulls. Bear bar 28, good for the bears, but is it a sell to close bar? It's not all that clear. We may end up have to go sideways for several bars. And then more bulls started giving up with 29, and we're testing down to 21. 29, strong enough bar, probably going to go at least a little bit lower. 30, hesitation, and a sign that we're probably not going to go a lot lower, but 3 consecutive bear bars, 28, 29, 30, probably first reversal up will be minor. And 31, follow through selling, good for the bears. But 2 large legs down, 22, 31, and the sell off to 21 is nested into 2 smaller legs here and here. And therefore, I suspect sellers above. And probably another leg down. Doji, not a good sell, so may find more buyers down here. And then outside up, 33, not a great buy, probably more of a minor reversal. And then follow through 34 consecutive bull bars. Good for the bulls, but realistically, after this kind of a sell-off, there's probably sellers somewhere above. $35, bear bar, but a doji. I suspect sellers above and a pullback. And then 36, good for the bears, but we may end up going sideways and forming a trading range here because we're low in the range from over here. And then 37, inside bar, buyers below. 38, bull bar, good for the bulls. A little bit of a challenge for the bulls. There's a couple problems. One, let's talk about the bears. It's a problem for the bears because we may get a bounce and a test all the way up to the open of the day, or even somewhere up here. And therefore, if you're a bear and you're short above the current bar, the high of 38, where are you going to put a stop? Are you going to put a stop above 34? Probably not. You'll probably get stopped out there. What about putting a stop somewhere up here? Let's say above the 31 high. Well, if you put a stop above the 31 high, part of my concern is this. 1 times the risk is all the way down here. And therefore, that lowers the probability that those bears are going to make money and increases the risk. That lowers the probability that the bears will make money. Let me say it differently. The problem with selling right there is risk reward. You have bad risk reward. So 1 times your risk relative to the reward, or 1 times your reward relative to risk, and probability is probably pretty close to 50-50. It might actually weigh the opposite. And so that's why I think a lot of traders would exit. The problem for the bulls is it's following. The problem for the bulls is it's a bear breakout to 31, and now we're forming a tight trading range below the moving average, and therefore it's slightly more bearish than bullish, and we may need a second leg down below 31. Let me get a sip of water real quick. 39, failed breakout for the bulls. Weak follow through buying after 38, probably buyers below 39. But this might be a triangle that gets trend resumption down. Part of my problem is 18 bar range. We have the high and the low created within the first 18 bars, and the odds are we're going to go above 12 or fall below bar 4. And right now, based on higher time frame context and the fact that we're closer to 4, makes me think we'll probably fall below the 4 low. And therefore, really not all that great of an environment. Not all that great of an environment for, I think that increases the risk that we go lower. 40 consecutive bear bars, 39, 40, but not a good sell signal bar 39, so probably buyers below. That's why we got the bounce on 41. 41, good for the bulls. Probably going to go at least a little bit higher. But look at the bar. It's 2 legs up. So for one, we have a triangle, and you get a bull breakout above the triangle. 50% chance it succeeds, 50% chance it fails at the moving average. A little bit problematic. And then the other issue for the bulls is that if you're buying right here, the other issue for the bulls is the other issue for the bulls is this might be a failed breakout of the 34 high, and therefore we get a reversal down and a test of the 7 low or the bar 4 low, tail above the bar. If this was such a bullish environment, why are we closing at the moving average instead of, why are we closing at or below the moving average instead of far above it? And then you can see what happened with 42. 42 sold off, and then it made it difficult for traders to sell the close of 42. 42, big bear bar, climactic, and therefore we may get a pullback. 43, bull bar, good for the bulls. However, buying above 43 might be more of a pullback from 42 than the start of a strong reversal. You can take the buy, but I think most traders are going to be quick to exit. 42 is a little bit of a surprise, and we may go a little bit lower. Plus, something important with 42. It's testing the low of 7. You can see the low of 7, 78.5. The low of 42, 78 and 0.75. So it came within a tick of 7 and held above it. And theoretical bulls who bought the low of 7, 1 tick above 7, arguably they got filled. Odds are we're probably going to fall below 7 because it's a trading range, and 7 is a big outside bar, and therefore it's common for traders to put a stop right there and for the market to run the stops. It's why people, it's kind of funny, people always say, oh, the market's always gunning retail trader stops, or it's always gunning my stop or stopping me out. It's because you're putting your stop at an obvious support or resistance level. And if the market's in a trading range, it's often going to fall below that level or go above it. 43, bull bar, but probably minor. And then 44, doji. Not really what you want to see if you're hoping for a strong reversal up. Probably buyers below 44. However, because we're low in the range, I think we'll probably fall below. However, because we're at the 7 low, I think we'll probably have to fall below it. And then 45, big bear bar, probably going to go at least a little bit lower. 46 consecutive bear bars, 45, 46, good for the bears. And to sell to close, not really. I think the downside's probably limited, and we may find buyers at the blue line, the midpoint of the August rally. On the daily chart, that blue line is this right here. It's the midpoint from the August low to the August high. Another bear bar, probably going at least a little bit lower, but 3 consecutive bear bars with tails above and tails below, probably not going a lot lower. Then we got the reversal up 48, possible low of the day. Always in bears, I'd get out above 48. Bulls they can buy stop below 48. Or maybe a stop twice the range down. Follow through 49 consecutive bull bars, 48, 49, probably going at least a little bit higher. And then we got the rally 50, 51. Strong enough reversal, probably the first reversal down will be minor, so good for the bulls. Bulls are hoping that this will lead to a test of the high of the day. However, market's in a trading range, and we're near the middle of the range, and that lowers the probability for the bulls. Testing near the open of the day, bar 52, pulling back. A warning that this might be a buy vacuum test of support, or buy vacuum test of resistance. probably going to pull back, but I suspect the pullback's probably going to be minor. And then a bear bar, 53, probably buyers below and sideways. 54, bull bar, high one buy, probably sellers above and more sideways trading. And then we tried to break to the downside, 55, and we found buyers, 57, bull bar closing on its high, second entry, probably sellers somewhere above, but this might be the start of a second leg up. At a minimum, I think we're going to go above the 52 high in the open of the day. 58 consecutive bull bars, good for the bulls, probably going a little bit higher. And then doji 59, so a sign of hesitation. And then 60, bear breakout. Is 60 enough for bulls to get out? They might, but the reality is bottom of a tight trading range. 60 could fail to break below the low of the range and reverse back up. 61, bull bar, not a great buy, not a great sell above, not a great buy because of 60. But I suspect, if I had to pick a direction, I'm going to pick long, betting we break to the upside. Follow through, 62, good for the bulls. But after bar 60, it increased, and the fact that 62 is at the top of the range increases the risk of a pullback. And then 63, bear bar, closing on its low. Because of the sell-off, 60 and 61, the risk for the bulls is that we have to test back down to the 61 low and relieve the bears. And therefore, the problem with buying right here is that it increases the risk that the market will test back down to the 61 low. So if you're buying 63, you cannot have a stop one tick below 61. Because the market might trigger the sell and reverse up. 62, micro double bottom, 61, 60, or 64 double bottom with 61, 64, but a bear bar, probably not going a lot higher. $64 bull bar, probably going to get a bounce. And we try to get the bounce with 65, 66, 67, but possible failed break out of the range. Looks like we may just go mostly sideways here. 68, another bull bar, but probably looks more like a bull leg in a trading range. And you can see part of the issue with 69 and 70 is the risk is big for the bulls. Theoretical risk is all the way down here. And therefore, you'll have traders buying below, scaling in lower. So really not ideal. That's what makes it difficult to be buying and selling in the middle of the range. The risk is big and the profit potential is relatively small. Bull bar 71, but probably not going a lot higher and may go sideways. And then we reverse down to 75, but possible bottom of this trading range here. And there might be more buyers below. And you can see we basically just went sideways into the close. Give me just one moment here. For stop entries, well, that first credible, and it's a little bit tricky. First credible buy, arguably above 7, but the risk is just really big, so it's not a great trade. And then some bears, they'll sell below 13, not ideal. What about selling below 14? You're selling in the middle of the range. If you're selling below 14, I think you really have to be able to scale in higher. and therefore it's probably just better to sell the pullback. But when you get the pullback 19, it's really hard. It's really difficult to be willing. It's really difficult to sell below 19. It's a doji, not a great looking sell signal bar, and it just looks weak, and it's following a bull micro channel. Trading ranges are always trying to trick you and make you think that you're selling something. You make you think like you're doing the wrong thing. And the problem with the trading range is what appears high probability is lower probability, and what appears low probability is higher probability. So what I mean by that is 60% is really not 60%. It's more like 55%. And then what appears to be 40% is not 40%. It's more like 45%. So everything gets squeezed closer to equal or neutral. And therefore, higher probability events have a higher rate of failure, and lower probability events have a higher rate of success. So just because you see a micro channel, and normally the odds are you'll get a second leg, isn't always the case. Bears, they can sell, but they probably get out above 22. Bulls can buy, but they got to get out somewhere in here. All of this is minor, and so they got to be quick to exit. Bears, if they sell 28 or sell 29, they probably get out above 38. And if they understand what's going on, some will sell below 42 or 44, not ideal. Others will sell as 42 reverses back down. And if you sell below 45, which is tough, you get out above 48. Bulls, they can buy 48, they can buy 49, they can buy 50. But if you're buying 50, you got to be prepared for a tight trading range because it's relatively high in the range, and the minimum target is the high of 41. And we may just go sideways around the 41 high in the open of the day. And then all through here, it's a mess. If you're buying here, it's easy to short here, then buy here, then sell here, and take a loss. Really not ideal. And therefore, it's better to really be waiting. Better to wait and just do. Once you see a tight trading range, it's really better to stop trading with stop orders. And for most traders, that means stop trading. Limit orders, lots of limit order trades. You could buy below 3 if you're willing to buy more below 1. But, tough to do, especially on the open, because the range is going to get bigger than the first 3 bars. I thought buyers below, once you got the reversal up on 4, I thought buyers below 5, buyers below 6. And I thought sellers above 15, but many traders aren't going to sell above a bull bar. Therefore, better to sell above a bear bar, or better than even that is wait for the rally to begin to appear to fail, such as above 18 or on the reversal down 19. And then I thought probably sellers above the 19 high or above the doji 26. Looks like we're forming a trading range. We may test back down to 21. I thought buyers below 40, 20, 32, but not ideal. And then I thought sellers above the 32 high, but that's really tough, especially when you're getting a breakout of a triangle. And then I thought probably buyers below 47 low for a bounce. And I thought buyers below any of these bars, even buyers below 60. And at this point, I'm not going to sell. Too much risk we get a second leg. And up here, sellers above the high 1, but too late in the day. And then buyers down here, but too late in the day as well. Buy the close, sell the close. Not really any great buy the close, sell the close. Maybe just buy the close of bar 7 or 8 for a small profit. And then if you sell the close of 14, really a bad trade. You probably have to scale in. And you can scale in. It's okay. You can see traders who sold the close of 14. You can tell it's a reasonable trade because if they did sell the close of 14, they got almost 1 times the risk. So if they sold 14 and sold more higher, they would have made arguably more than 1 times the risk, but still not a great trade. And then I don't think any of this is buy the close, sell the close, maybe sell the close 29.30, but big bars increase the risk of sideways trading, so not ideal. Probably buy the close 49.50, but you can see even if you did, you didn't even get a measured move of 49.50 because of all the trading range price action. Let me take a look at questions. Can you give us your thoughts on trading after the 4 p.m. close? Yeah, so basically, what the person's saying is, what about holding a position into the overnight hours. I think it really just depends on context. My problem with that is I've done that several times, and what I've concluded is it's one thing to establish a position on a higher time frame that you're willing to hold for several hours or even overnight. That's a whole totally different thing. But look right here. Just what do you think this is going to lead to a lot of trading up or down? Probably not. So for me, if I'm going to do that, I start thinking about 60-minute charts. Maybe something like that. If I'm looking for a double bottom, I might be willing to buy and then buy more down here and put a wide stop. But the reality is, I like trading the 5-minute chart of the Emini, and therefore I'm going to be way more inclined to just wait and close it. The other thing is, I think one of the problems is when you're trading this time with this chart right here, and you're holding for one of two reasons. You're holding because you think the market's going to do something over the next several hours, or more likely you're holding because you want to stay in a position and try and make more money. So what I think about is this. I'm willing to hold for me, if I'm willing to hold into the close, it's usually based on a higher time frame. And most of the time, if I want to trade the Globe, if I think there's going to be a lot of movement in the Globex hours, I'm just going to trade it when it opens. I'm going to close the trade because even right here, really not, it's tight trading range. My preference is to trade different markets on higher time frames. Like a crude oil chart, we've had a lot of kind of bad price action, a lot of just small bars. I might trade a 60-minute chart of crude oil. I haven't traded it in a minute, but generally what I would do, maybe gold, trade a higher time frame of gold. And then, some Forex markets, but primarily I'll just look at the 5-minute chart of the Emini. And what I'm more prone to do is look at a 15-minute chart as well of maybe gold or crude oil an hour or two before the open, and then see if there's a swing position and maybe establish a position. That's my overall thoughts, though. All right, so it looks like that is pretty much it for questions. As far as tomorrow goes, I suspect that we're probably going to get a bounce, and I suspect the downside is probably limited, but we'll see. All right, thanks everyone, and I hope everyone has a great rest of their day.